Welcome, financial leaders and Treasury professionals. Today, we are diving into a critical transformation journey, streamlining and rationalizing redundant structures. In an era of rapid global expansion and M&A, treasuries often become tangled webs of redundant accounts and systems. Let's learn how to cut the bloat, unlock trapped cash, and build a sleek, highly efficient global treasury. Let's start by defining what we mean by streamlining and rationalizing redundant structures. In the context of corporate treasury, this is the deliberate consolidation of fragmented units, redundant bank accounts, and disparate IT systems into one unified architecture. The basics involve identifying overlapping processes like multiple subsidiaries using completely different banking portals and centralizing them. Why is this necessary? Because as businesses grow globally or merge with other companies, they inherit massive complexity. This unchannelized growth creates trapped cash and misaligned FX hedges because no one has a clear, global view. How do we fix this? We start by creating an integration management office to lead the charge, rationalizing bank accounts, and deploying unified technology. As we dive deeper, understand that eliminating redundancy isn't just an accounting cleanup exercise. It is a strategic mandate that transforms your treasury from a reactive, bloated cost center into a sleek, proactive control tower for the CFO. Take a look at this flowchart outlining the rationalization trigger and response. At the top, unchannelized corporate growth and M&A activities inevitably lead to the second node, fragmented systems and redundant accounts. When a company reaches this breaking point, it enters the central treasury rationalization gateway. From here, the strategy splits into three concurrent execution paths: bank account consolidation, TMS and ERP integration, and policy standardization. By executing on all three fronts simultaneously, the organization drives down into the ultimate goal at the bottom, a streamlined, agile treasury capable of supporting global scale without the dead weight of legacy redundancy. Before we can streamline, we must accurately identify the cost of our current redundancies. What does this mean? We must audit the entire enterprise to uncover the hidden financial, operational, and risk costs tied to duplicated structures. The basics require mapping the as-is state. It is surprisingly common for a growing global firm to suddenly realize it is juggling over 150 banking relationships and thousands of local accounts. Why does this happen? Because local subsidiaries love autonomy. But this autonomy results in excessive intercompany billing, manual reconciliations, and overlapping fees. How do we audit this? We leverage APIs and Swift data to perform a global sweep of all balances, actively hunting for inactive accounts and trapped liquidity. In our deep dive, I want to emphasize that the true cost of redundancy is not just paying too many bank fees. It is the idle cash penalty. It is the tragedy of subsidiary A borrowing expensive external debt, while subsidiary B sits on millions of idle cash in a forgotten, redundant account. This mind map visually breaks down the costs of redundancy into three major impact zones: financial drag, operational inefficiency, and elevated risk. Under financial drag, redundant accounts directly cause high bank fees and trapped liquidity. Under operational inefficiency, having multiple, overlapping systems forces teams into manual reconciliations across disparate ERPs. Finally, under elevated risk, a decentralized, bloated structure leads to blind FX exposure because you can't hedge what you can't see and inconsistent controls, which opens the door to internal fraud. Streamlining eliminates these toxic branches entirely. Now we move to execution, starting with the most critical step, bank account rationalization. What is this? It is the aggressive reduction of hundreds of localized, fragmented bank accounts down to a tightly controlled network of global partner banks. The basics involve a ruthless campaign to close inactive accounts, eliminate local cash hoarding, and replace them with centralized structures. Why is this our first target? Because the financial wins are immediate. For instance, post-M&A, leading industrial firms have identified over $500,000 in pure annual cost savings solely by closing redundant accounts. How do we execute this? We conduct a rigorous RFP to select one lead bank per region, shifting from fragmented local pricing to highly leveraged, global relationship pricing. Diving deeper, the technical solution to replace these accounts is the Zero Balance Account, or ZBA. By setting up ZBAs, local entities can still process daily payments, but at the end of the day, every single dollar is automatically swept into a master corporate header account. The redundancy is gone, and liquidity is 100% centralized. Let's compare the before and after states of bank rationalization on this flowchart. On the left, before, we have subsidiaries 1, 2, and 3, each holding redundant cash buffers in completely different local banks. There is no synergy. Now, follow the rationalization arrows to the right. In the after state, those local accounts have been converted into zero balance accounts, ZBAs. Notice the dotted lines. These represent automated end-of-day sweeps that push all liquidity up into a single master corporate header account held at a global partner bank. We have collapsed 3 redundant banking relationships into one, instantly achieving total cash visibility and vastly reducing fees. Next, we tackle technology and system rationalization. What are we fixing here? We are dismantling the patchwork of disparate ERPs, fragile legacy spreadsheets, and localized software, replacing them with a single, unified cloud-native treasury management system. The basics require adopting an API-first architecture to finally establish one single source of truth for the enterprise. Why must we do this? Because paying to maintain overlapping IT systems is incredibly expensive, creates dangerous data silos, and completely blocks our ability to achieve straight-through processing. How do we unify our tech? We leverage the Common Global Implementation, or CGI, running on ISO 20022 standards. This allows us to speak one standardized digital language to all our banks. On screen is a simplified sample payload mapping. Rather than logging into 5 different bank portals, our unified system fires one standardized instruction to route funds globally. Our deep dive reveals the genius of CGI. It uses data over population. Our TMS sends one massive, standardized data payload, and the receiving banks simply filter out what they don't need. Redundant bank portals are eliminated. This diagram maps the technological migration. Look at the fragmented IT box on the left. We have legacy ERPs and acquired company systems dumping data into isolated local bank portals, fragile spreadsheets, and requiring heavy manual entry. It is an operational nightmare. Now, trace the migration paths to the right into the rationalized architecture. All those redundant systems have been collapsed into one unified cloud TMS. From this single hub, we use standardized ISO 20022 and APIs to communicate seamlessly with the global banking network. Furthermore, this clean, unified data flows downward into our data lake, enabling the deployment of advanced analytics and AI. Streamline tech is the prerequisite for intelligent treasury. With our banks and systems rationalized, we must streamline the actual flow of money using netting. What is netting? It is the process of consolidating redundant, high-volume gross intercompany payments into a single, periodic net settlement. The basics are simple. Instead of subsidiary A wiring money to B and B wiring money back to A for a different invoice, a central netting center mathematically offsets the amounts, and only the net difference is transferred. Why is this a mandatory streamlining tactic? Because it instantly eliminates the sheer volume of redundant cross-border wire transfers, slicing banking fees, and eradicating FX conversion friction. How is it done? We run a multilateral netting engine inside our unified TMS that aggregates global payables and receivables. Let me illustrate this deep dive with hard data. Through multilateral netting, a chaotic web of 14 separate cross-border intercompany invoices can be mathematically compressed into just one single net payment. You are achieving upwards of 90% transactional efficiency simply by rationalizing how money moves internally. Compare the 2 models on your screen to understand the power of netting. The top box shows redundant gross flows. Sub A pays sub B 100K, B pays A 60K, and similar redundant flows happen with sub C. That is 4 separate, costly cross-border bank wires, each incurring FX fees. Now look at the bottom box, streamline netting. The netting center has done the math. Sub A simply pays its net obligation of 40K to the center. Sub C pays its net 30K. The center then makes one single payment of 70K to sub B. For expensive bank transactions have been rationalized down to 3 domestic equivalent transfers. It is pure operational elegance. To sustain our new architecture, we must execute process and policy standardization. What does this mean? We must aggressively eradicate outdated, conflicting local treasury policies and enforce a single, unified global treasury policy. The basics involve standardizing everything, from risk tolerance limits to authorized bank signers to daily reconciliation checklists. Why is this critical? Because decentralized, redundant policies create fatal control gaps. History proves that inconsistent, maker-checker rules across subsidiaries are the primary breeding ground for massive internal fraud. How do we secure the firm? We establish a global mandate that strictly governs system access and segregation of duties, enforced by a unified middle office. Drilling into the deep dive, standardization allows us to apply the trust but verify principle at a global scale. We strip away redundant, localized manual checks and replace them with continuous, automated control analytics embedded directly into our new, unified TMS workflows. We streamline the rules to maximize protection. This structural diagram maps the governance cleanup. We begin at the top with conflicting legacy policies, the messy reality of a decentralized firm. We push these through the policy rationalization process to forge a unified global treasury policy. Notice how this master policy cascades down into our 3 operational pillars. The front office gets standardized execution rules. The middle office is armed with automated controls. The back office is streamlined for straight-through processing, STP, settlement. All 3 of these branches are tightly bound by the decision diamond at the bottom, segregation of duties enforced. By removing redundant local rulebooks, we create an airtight, unified control environment. Let's apply these streamlining concepts to a highly relevant, real-time use case, post-M, and a treasury integration. The scenario: a multinational completes a massive acquisition. They inherit a chaotic, decentralized treasury footprint containing over 2,000 legal entities and 200 redundant banking relationships. The problem: the new combined entity is bleeding cash. They suffer from millions in trapped liquidity, completely blind FX exposures, and skyrocketing, overlapping banking fees. The execution: a dedicated integration management office springs into action. They execute a ruthless rationalization plan. They replace the legacy systems, close hundreds of redundant local accounts, and consolidate down to one lead partner bank per country. The result: by streamlining these accounts and funneling the cash into global ZBA pools, the Treasury immediately saves over $500,000 annually just by eliminating redundant bank fees. But the ultimate strategic win is that the newly unlocked trapped cash is immediately redirected to pay down the massive M&A acquisition debt. Rationalization literally funded the buyout. Follow the timeline of this M&A integration on the sequence diagram. First, the acquired entities reveal their chaotic state to the Integration Management Office, 200 redundant bank accounts discovered. The IMO immediately pushes back, initiating the audit and closure of inactive accounts. Next, the IMO works with the lead global bank to consolidate relationships down to one per region. The global bank then establishes ZBA sweeps directly into the unified TMS, creating a massive liquidity pool. Inside the TMS, the system calculates the newly unlocked trapped cash, allowing the IMO to immediately deploy those savings over $500,000 to pay down the M&A debt. A perfect streamlining execution. As we conclude, you must understand a harsh reality: streamlining is not a one-time project. Without ironclad governance, account bloat and shadow IT systems will slowly creep back into your organization. To sustain our rationalized architecture, we must enforce continuous review. You must institutionalize annual bank account audits and mandate strict, senior-level approval before any subsidiary is allowed to open a new local bank account. Looking to the future, world-class treasuries are now leveraging AI and machine learning to continuously scan their global networks, automatically detecting redundant payment flows or new pockets of trapped liquidity before they become a problem. In summary, eradicating redundancy is how you transform a bloated, manual back office into a high-speed, predictive control tower that drives massive enterprise profitability. I hope this training has empowered you to rethink your organization's architecture. Please invite learners to like, subscribe, and visit quicktechie.com for premium certification prep, including Q&A banks, full ebooks, audiobooks, full-length training, and interview guides. Thank you for watching. Our final diagram illustrates the continuous improvement loop required to maintain your streamlined treasury. We start at our new streamlined baseline. This must be protected by strict account governance. We then apply continuous AI monitoring to scan the enterprise. This brings us to the decision diamond: anomaly detected. If yes, meaning a new redundant account or process is found, we trigger immediate rationalization, which cleans it up and resets our baseline. If no, we successfully maintain our sustained strategic control tower. This endless loop guarantees that your treasury remains lean, agile, and fiercely protected against future redundancy.